Offset mortgages can help you pay off your mortgage more quickly. In this video, I'll be discussing what an offset mortgage is, how it works, and how it can potentially benefit you. I'll take you through some of the pros and cons, and I'll also include an example for you. Hi, this is Sam from Rosehill Financial Services, and I'm here to help you in your buying journey. If this is your first time watching, then do consider subscribing to the channel, as I'll be bringing you content each week. So first up, what is an offset mortgage? Well, put simply, an offset mortgage allows you to link a savings account to your mortgage. The savings account will be provided by the particular mortgage lender that you choose to proceed with. Now, the amount of savings that you put into this linked account will help you reduce the overall amount of interest charged on your mortgage. But don't get this confused with reducing the actual capital amount that you owe. You still will need to repay this back in full. But an offset facility does help to reduce the overall amount paid by helping reduce your interest payments. You'll then generally have two options. So you can either choose to reduce the mortgage term, so the amount of time that the mortgage runs for, or you can choose to reduce the monthly payments. So how does it work? Although an offset facility can help you save money, this isn't always the case. I'm going to give you a very simple example in this video, but I'd strongly recommend speaking with a broker in detail to know whether or not this type of mortgage is for you. So to give you a simple example, let's make the following assumptions. So first off, you'll be taking out a mortgage of £300,000. This will run over a mortgage term of 25 years. And the interest rate is fixed at 2.5%. The mortgage is arranged on a capital repayment basis, not an interest-only basis. You have £50,000 in savings, and you are a higher rate taxpayer. We'll also assume for this example that you won't be making any further payments into this linked account. So assuming that all of these factors remain the same throughout the full term of your mortgage, if you chose the option to reduce the mortgage term, then you could pay off your mortgage 2 years faster, saving you over £10,000 in interest payments. Or if you wanted to reduce the monthly payments instead, then using the example above, you could save roughly £97 on your mortgage each month. And this would lead to a saving of £29,000 in interest payments over the full 25-year mortgage term. Now, this is without adding any further payments to that linked account. So you could potentially reduce the mortgage term or the monthly payments even more than that. In addition to this, lenders that offer the offset facilities will generally allow you to make overpayments on your mortgage as well. And this can help to reduce the debt even more quickly. You'll just need to check any details of early repayments that may apply, just to make sure that you don't get penalised for any overpayments that you make. So you can see how an offset facility could really help you reduce your interest payments over the term of your mortgage. I'll link a couple of offset calculators in the description as well, just so you can play around with some of the figures. So you might be thinking, well, what are the downsides? So as discussed, to keep things simple for this video, we've made a lot of assumptions on this example that we've used. Now, these assumptions are very likely to change throughout the mortgage term. For example, interest rates are subject to change throughout your mortgage term. So the figures in this example would fluctuate. This will of course make a difference to the overall amount of interest saved. The same goes for interest rates that would apply to any savings accounts that you could open separate from the offset facility when you're looking into your comparisons. Speaking of savings accounts, any accounts that you may have, so not this linked offset mortgage facility, will generally pay you interest. And this usually isn't the case with accounts that are linked to an offset facility. So when comparing a standard mortgage to an offset mortgage, you'll want to factor in the interest that you can make on any other savings accounts. Where a linked account on a offset mortgage generally won't pay you interest, you'll also want to factor in inflation. So not to go into too much detail on this to avoid any confusion, but the money that's sitting in this linked account, if it's there for a long while, then inflation will be eroding this money. So the purchasing power of this £50,000 is going to be less in 25 years than it will be now. So that's also something that you're going to want to factor into your decision making. It's also key to point out that offset mortgages may come with a higher interest rate. So you'll want to factor in this additional cost when comparing a standard mortgage to an offset mortgage. And lastly, not all mortgage lenders will offer an offset mortgage, so you may be quite limited in terms of options available. The good news is that offset mortgages are generally pretty flexible when it comes to withdrawing money or depositing money into that linked account. Just remember, at the point you withdraw any money, then the interest payable will increase, but on the flip side, anytime that you want to deposit more money, you'll be saving yourself more and more in interest payments. Now, one option that might be available to you is having an offset mortgage on an interest-only basis, although you will need to fit certain criteria for this arrangement. Now, this isn't for everyone because you won't actually be paying any of the mortgage debt back on a monthly basis. You'll only be making payments towards interest. You will need a separate repayment strategy to make sure that you can repay the debt at the end of the mortgage term. I have made a separate video which explains repayment versus interest only mortgages in a little bit more detail, and I'll link that in the description below. So for those of you looking to lower your monthly payments with an interest only mortgage, you might want to consider the option of an offset mortgage. With a £300,000 mortgage at a 2.5% interest rate, similar to the example that we gave previously, your monthly mortgage payments would be £625. If you had the same £50,000 in a linked savings account for your offset mortgage, then you'll reduce those monthly payments to £520. Again, you'll generally have full access to these funds if you do need it, and you can also contribute more funds to this linked account to reduce those monthly payments further. So just to summarise, here's a few pros of having an offset mortgage. Firstly, you can help reduce the overall amount of interest paid on your mortgage. You can either choose to shorten the mortgage term, so pay off your mortgage more quickly, or you can choose to lower the monthly payments. Lenders may also allow you to make overpayments to help you reduce that mortgage debt even more quickly. Just remember to keep an eye out for any potential early repayment charges. You could potentially save yourself more in interest payments on your mortgage than you could earn interest from a separate savings account. You pay no interest on the tax that you save, whereas in a separate savings account, you might need to pay tax on those earnings, and you still generally have access to those funds as and when you need. In terms of the downsides to an offset mortgage, interest rates are generally higher with an offset mortgage compared to a standard mortgage product. It's very unlikely that you'll be paid any interest on money held in this offset account. Your savings may be eroded by inflation, meaning that the purchasing power at the point you take the money out may be lower. You'll be limited to lenders, as not all lenders will offer offset mortgages. You might find it's more cost effective to go for a standard mortgage product and setting aside your savings in an interest paying savings account, depending on the deals that are available. On a final note, I just want to say that it's very rare that you choose one mortgage product and stick to it forever. You'll generally find that it's more cost effective to remortgage every few years, depending on when your existing mortgage product expires. So this means that you can review your options every few years when you look to remortgage. An offset mortgage might be the most suitable option for you right now, but it might not be the case when you come to remortgage. So let's hear from you. What type of mortgage are you looking for? Do let me know in the comments. If you'd like any further information at all, as always, feel free to leave me a comment below or message me directly and I'll be happy to help. All links are in the description of this video. Before I let you go, I must tell you that as a mortgage is secured against your home, it may be repossessed if you don't keep up the repayments. Thanks again for watching, and I'll see you in the next one.